Thank you for coming. Thank you for coming to the conference. Thank you for coming to my presentation. I'm getting over a cold, so if I sound a little stuffy, I apologize. So the last time I was here, I talked about how, there's going to be one more decline in the gold stocks, and then it could set up just this epic generational buying opportunity. And we can't predict the future. We don't always get it right. And it turned out that looks like that's playing out. So today I'm going to talk about, we have this, what I think is going to be a final decline in the gold stocks. And then, what's setting up for the outlook in the 2020s. And I'm going to talk a little bit about commodities, but, mostly about the gold stocks. So getting into it, the three things. Okay, so the three things I'm going to talk about are the current setup of where we are and what that compares to best historically. I think there's a strong historical comparison for where we are as far as the stock market, commodities, macro, and then a little bit more on the present situation. Okay, so let's talk about the current setup. So here we have the gold stocks against the stock market. There's two historical indices for gold stocks. We have the S&P TSX and then the Barron's Gold Mining. And as you can see, it looks like from a bird's eye view, the gold stocks relative to the stock market are bottoming. And that's from a bird's eye view. So we're talking about not like a 1 year, a 2 year view. We're looking at like a 5, 10 year view. So gold stocks against the stock market, they're trading around and about to, in the years ahead, move off of, what looks to be an epic low. You go back to the end of 2015 and that low, that was the lowest all time for these ratios. So that's really impressive. Gold stocks against gold. We have the same two indices divided by gold. It's a similar picture. We're coming off of a long-term bottom in these charts. And one more on this front. So I'm using the S&P TSX gold index here in monthly data, just looking at the rolling 10 and 20-year returns. And as you can see, based on this chart, there's really only two other comparable points in history. And that's, you have to go to the late 50s and early 60s. You have to go to 1999, 2000. And so those best compare to where we are now and where we were 3 and 4 years ago. And here's one more on the valuation front. This is from Scotiabank and GBM, just looking at the price to net asset value for gold stocks. And as you can see, this goes back 35 years or so, and we're, at the end of 2015, it was at the lowest point. This is not, I don't think it's updated in the last couple of months, but I think we could come back close to that 0.7 low, that we almost hit about 9 months ago or so. Okay, here's another interesting chart. We have commodity stocks against the stock market, and specifically against the Dow. And we can see, that's just been a massive, sharp decline over the last 10 years or so. And that's based on this ratio, that is at an all-time low. So of course, the question is, something has to happen. There has to be a catalyst to turn these things around. And if over the last 65 years, there's been 13 rate cut cycles. In 11 of those, the average gain that gold stocks had coming off the bottom was 172%. So that poses the question, when is the actual bottom? And so looking at the data based on the gold stocks, it's a little messy, but the median and average tends to be 1 to 2 months before the first rate cut. So if the Fed is going to do a rate cut in September, perhaps gold stocks could bottom August, or maybe even a little bit before that. The data for gold, there's not as much because the gold price obviously was fixed until 71, so it doesn't have the history. But the data for gold, it's very similar, but gold sometimes can lag. It can sometimes bottom like a month or two after the cut, so that's something to keep in mind. But it's going to depend on the Fed cut. Are they going to cut in September? Are they going to cut in September? Are they going to cut in December? Is it going to be next year? A couple days ago, the market was showing an 80% chance of a rate cut this year, so I would say September or December. And moving on, let's talk about historically, where we are. What obviously patterns in history, they tend to repeat, they tend to rhyme, they don't repeat exactly. But where we are now, we basically have the stock market at an all-time high. It broke out 6 years ago, so it had a major breakout. It's in a secular bull market, but valuations are near extremes. And also, looking at inflation and bond yields, those are probably at a secular low point, and over the coming years, they're probably going to turn higher. And then, of course, gold stocks are historically cheap. So I hear some people saying, this could be like 2008 again, or the late 90s. I thought it was the late 90s, but to me, it's really the early 1960s. All those things fit up with the early 1960s. So that's where we are. And so looking at the stock market, the VP means valuation peak, and BO just means breakout. So the stock market is at an interesting point because it's had this major breakout, and we can't deny it. It's in a secular bull market. However, the valuations are near extremes. So how much longer can the secular bull market really run if valuations are near extremes? I mean, we have people thinking we're in the 80s or the early 90s where there's all these many years that the stock market can continue to run, but that doesn't really make sense. I mean, if we look at what happened in the 1960s, I think breakout number 2 occurred in 1954, and then we had the valuation peak there in the mid-60s. You can see that the S&P 500 still made higher highs. They were slightly higher highs. The same thing happened if you go to the beginning of the chart and you go to the early 1900s. There was a valuation peak, but the market over the years ahead of that still made slightly higher highs. So this wasn't, in that case, and then in the 1960s, it wasn't a rip-roaring bull market, but the stock market was grinding higher. It was making, slightly higher highs, while valuations were coming down. And during those points, that's when inflation was starting to take off. So I really like the comparison to the early 1960s. And it also fits with where inflation is. This is monthly data here, and looking at the rate of inflation. And look, when we're looking at the rate of inflation statistically, it's basically commodity prices, the rate of change for commodity prices, or to make it even simpler, you could say energy prices. So when we're talking about the CPI and statistical inflation, we're not talking about the cost of living. That is something different, obviously. The cost of living is going up much faster than what statistical inflation shows. But if we're looking at, again, the comparison to the 1960s, if you look and zoom in on the mid-1960s to late 1960s, there at about 1964 or so, the CPI started rising, it started breaking out, and then I think it was 1968 when the CPI had a major breakout. The first breakout there in the mid-60s was above 2%, and then I think it was 3.75% in 1968, the CPI went above that. That was the highest in 17 years. And so where we are now, the rate of inflation, statistically, it hasn't been basing. We've kind of been in this downtrend for 30 years. And so to break above the downtrend line, we'd have to get above 3%. So 3%, that's a critical level for the rate of inflation. And getting deeper into the comparison, in this chart we have, at the top we have the Barron's Gold Mining Index against the stock market. Then in the middle we have the stock market. And at the bottom we have the CPI. And so the main takeaway here is that the gold stocks actually bottomed relative to the stock market in 1960, and then they started outperforming. Silver actually bottomed in 1962. Gold was fixed, but silver was trading. So this gold stock index, in relative terms, bottomed 1960, silver 1962, and the CRB, as far as commodity prices as a whole, they began to outperform the stock market in 1968. And not by coincidence, that happened right after the rate of inflation broke out, went above 3.75%. And I mean, looking at, if we look at the middle in the S&P 500, we can see that even though gold stocks were outperforming in the early 60s, the CRB started outperforming at the end of that decade, the S&P was still making gradual higher highs. So the bull market had ended in real terms, but it kept going. It made those slight higher highs. So that's something I think we could see again. And the real key, well, I think I'm going to mention this later, so I'll just stop. But so looking at the 1960s, this is performance from 1960 to 1967. And the S&P TSX Gold Index and Platinum, they had really big moves from 1958 to 1960. So if I did this from 1958 forward to 67, those two things, they would show a much higher percentage. But, you know, we think about the 70s and inflation, but I mean, that was really set up by the 1960s. And it's interesting because the CRB, I think, bottomed in 1968. But I was looking at just various metals prices and how they performed in the 60s. Silver, as you can see, it almost tripled in the 60s. Platinum from 58 to 1967, I mean, it had a huge move. I think it was almost 400%. And there were other metals too, like palladium had a big move. A couple of the base metals, not copper, but I think maybe zinc and something else had a huge move in the 60s. So, but the reason these things did not show up in the CRB was because energy prices did not move until the end of the 60s. And the ags and the softs, those commodities, they didn't move until the end of the 60s. So that's why the CRB, you didn't have much of a move in the 60s, even though there were a handful of metals that did move quite a bit. And this is another thing that's really interesting. I'm not a big cycles guy as far as technical analysis, because a lot of the problem with cycles is people they say, oh, I have this cycle, and then they try and map the market to it. So I never use cycles because I think you need to read the market. That's what's objective data. So when you're looking at cycles are kind of subjective, but W.D. Gahn, who is a big figure in technical analysis, he was a cycles guy, and his biggest cycle, and this was like in the early 1900s, his biggest cycle was the 60-year cycle, where you tend to have bottoms and peaks and various things every 60 years. And like I said, I'm not a big cycles guy, but if we're looking at commodity prices, and as we can see there, we have the CRB on the left, silver on the right. If we're looking at commodity prices, they tend to have peaks every 30 and 60 years. So the 60-year cycle tends to be really strong, but again, if we're looking at this data, there's also peaks every 30 years. So the really significant peaks for commodities were just after the Civil War, so not exactly 60 years, but then 1920, and then 1980, obviously. So that tells us when is the next peak going to be? 2040. So, you know, who knows? It could be 2035, it could be 2041, it could be 2037. We don't know, but just this history and the 30 and 60-year cycle gives us a guidepost of what to look for. So with respect to you know, gold stocks and hard assets, like we're not in a continuation of the 2000 to 2011 period. We're really going to be starting in the next couple of years a whole new upcycle that's probably going to last well into the 2030s. Okay, so let's talk about the present situation and where we are with precious metals. So, yes, I gave the comparison to the 1960s, but this is something very interesting with silver. Its price action, it looks like it's following the 1998 to 2001 period. And if you look at what happened, the price action is so similar because silver popped, then it had a sharp correction, then it consolidated for a while, well over a year, and then it broke down. It had this final decline into a major bottom. So where we are this time, well, silver had the sharp rise, and it had the sharp correction. the second half of 2016. Then it had this consolidation for over a year, and it's broken down from that. So silver looks to be in the last phase of its decline. Possibly, maybe it could bottom around $12 an ounce or some support there. Putting the comparison together on the same chart on the recent scale, this is what it looks like. So silver probably has a little bit more downside, but not necessarily a whole lot. Who knows? I mean, it could be 6 months, 4 months, 9 months. We don't know, but just there's more downside there, and 2020 is probably setting up pretty bullishly. Okay, so let's talk about the miners, and we'll get into some technical analysis. I use a lot of indicators, but what I'm going to focus on over the next couple months is here at the bottom, I show the percentage of stocks in the GDXJ that closed above the 200-day moving average. And as you can see, you go back to 14 and 15, you can get a positive divergence like that around major lows. So this indicator is at 37% as of yesterday or the day before. But I want to see that. It's too soon to buy now. I mean, the market's weak. It's trending down. So it doesn't necessarily have to go to 0 or 5% to mark this great buying opportunity. But I want to see that get below 20%, 15%. And when that happens, we'll know that the market, GDXJ, is getting to that extreme oversold condition where, based on not just the 200-day moving average, but I also look at percent that closed above 20-day, 50-day moving average. So when those are all really, really oversold, and then the market is near a strong level, like it could be 26, it could be 24, then you have the setup for a rally, and who knows, maybe that'll be around the time when the Fed cuts rates. So that's what I'm looking for. GDX, similar chart. At the bottom, I plot the percentage that closed above the 200-day. I use the Huey for that because the Huey is basically GDX minus the royalty companies. GDX, I mean, it's always changing its stocks, so that makes it more difficult to track the breadth. So that's why I just focus on the Huey. As you can see, that it does tend to come down below 10% around low. So that's at 42%. The large gold stocks are not, based on that indicator, they're not that oversold. They're obviously short-term oversold. So again, more work to do on the downside. Maybe GDX is going to come down and test that low from last year and turn up then and do a real bullish double bottom. Again, if that happens around the time the Fed cuts rates, there's your catalyst for a really good rebound that's sustainable. Okay, so just to conclude where we are now, there's 3 things to remember. The best comparison for where we are as far as the stock market, commodities, macro, et cetera, it's the early 1960s. Secondly, the rate cut. That is the key for precious metals and gold stocks. They're going to perform really well after we get that rate cut. And this bottom could be a month or 2 before the rate cut. We don't know. That's just what the historical data says. And then finally, this is the last point I was going to make earlier, but I stopped. Commodities as a whole, they will outperform stocks after the CPI breaks above that 3% trend line resistance. Because if we go back to earlier in the presentation, it was that CPI breakout in 1968. That was the point when inflation hit a 17-year high. It was trending higher. That was when commodities started outperforming the stock market. That's when the stock market stopped performing well in real terms. So as far as when that's going to happen, it will depend a lot on, when is the next downturn, how deep it is, when does the next recovery begin. But, that could be 3, 5, 6 years away, something like that, because, we could see this cycle. It's been really long. Maybe it extends for another year or 2. Then you get a recession after that. Then inflation comes down. Then they pump a lot of money in. We get massive government spending through MMT and all that garbage. And after that, I think that's going to set the stage for inflation to tick up and move higher. But again, if we're just thinking about, when could these things happen, it doesn't look to be like 1 or 2 years away. It looks to be after the next downturn. So we're looking out to the middle of the next decade when inflation could break out and start to move. And so that's, you look at and you think about how long things take to play out, and that's why the 2040 or the 2035, that's why that target makes sense for the next major peak for hard assets. Okay, the end. Thank you so much. And who's next?